I'm Ferdinand Sihombing.
Hi, I'm Jonathan Wijaya.
I'm Rubiati Inaya. We are from IPB Institute MBA program from Group 2, Shinta and Garry, and we are going to review the book from Peter Lynch, which entitled is The One Up on Wall Street, based on our studies from corporate finance that had been lectured by Professor Roy Sembel.
Prof. Roy is a great lecturer at our campus, an education content creator, and a grandchildren in academic of Nobel Prize winner.
About the book itself, it is a classic investment guide that advocates for the individual's investors' advantage over a Wall Street professionals. And Peter Lynch's main point is that the average investors can beat the professionals by using only their everyday knowledge and their common sense.
One Up on Wall Street by Peter Lynch is a classic investing book that explains how ordinary individual investor can outperform professional fund managers by using common sense, personal experience, and simple fundamental analysis rather than relying on market prediction or expert opinions. The Making of Stock Picker. This chapter is a brief autobiography about how Lynch developed into a top investor in the world. He emphasized that a great investor doesn't have to be born into a wealthy family or have innate talent. Quite the opposite, his long journey shows that investment skills can be honed to observation, experience, and curiosity. Where the early investment lesson he is a caddy golf led him to the world investment. The family environment is a skeptical stock that fear often causes people to miss a great opportunities. Academic experience is not the main factor. Logic and critical thinking are far more important than complex economic theory. Stock pickers are not born but made. He convinced that if we can do it, anyone can have the curiosity can do it. Next, the Wall Street oxymorons, professional limitation, and individual investment advantage. This chapter discusses the irony of the professional world on the Wall Street. Lynch called many fund managers oxymorons because despite their expertise, the working system made unfree and they often underperform amateur investors. Professionals are limited by rules, not by the lack of ability. They must follow list of permit stock, client pressures short-term result, and rules against exercise diversification. The psychological or political pressures means that if you buy a large stock and they go down, they are safe, fair value. But if you buy small stock and they go down, you are considered foolish. They prefer to be safer than right. The art mentality phenomenon on Wall Street. The professional wait for other analysis to make recommendation before buying. The result is they enter late, the price has already gone up. Is this the gambling or what? Is investing in a stock the same as gambling? Lynch replied, no, if done correctly. Common misunderstanding that many people equate investing in gambling because the results are uncertain. Lynch explained the different stocks means return 10% per year, but the bonds is 5%. Treasury bills is 3%. Stock provide 2-3 times to provide. Risk is every place, not just in stock. The risk is inherent. What matters is how you manage it. The analogy of stock poker. Investor tax stop if opportunities worsen, double down when opportunities are good. Passing the mirror test to determine if you are suitable for investing. This chapter forces readers to reflect and ask themselves if they have mentally and financially ready to become investor. Are you suitable for the investor? Investment needs a long-term patient ability to withstand mental pressure. Logic is more important than emotion. Is this good market? Please don't ask. This important chapter explains that predicting the market is a complete waste of time. Lynch himself cannot predict the market because if even professionals can do it, the amateurs shouldn't even try. All academics and analysts also fail. All prediction models were known are consistently able to make accurate prediction. The cocktail party theory. Lynch explained the behavior pattern of investors at the party, which reflected a market condition. penultimate, preparedness. Investors are always prepared for disasters that have already happened.
Let's move to the part 2, Picking Winner, in the book One Up on Wall Street by Peter Lynch. The content in this chapter are Stalking the 10 Beggar, I got it, was it? The perfect stock, what a deal, stock I'd avoid, and last, earnings. The key point in this chapter 6 is 10 Beggar is an investment, usually a stock that increased in value 10 times from its original purchase price. It signifies an incredibly successful long-term investment with similar terms like 2 Beggar or 3 Beggar. Identifying 10 Beggars involves finding small or mid-cap companies with strong earning growth, innovative product, and favorable industry trends, often by investing early in companies that become household names. Another key in this chapter is the best stock ideas come from everyday life. Investors already have an investing edge. Invest in what you know. Earning ultimately drives stock price. Hidden assets create opportunity. Results matter more than most investors think. Big companies, small stock move. Size determines expectation. Chapter 7, What to do after finding a stock idea. Investing without research is like playing a stud poker and never looking at the cards. We can identify that big companies is stable, slower growth, and small stock price movement. Small companies usually higher risk, greater upside. One product can change everything. The key point in this chapter is size determines expectation. Don't expect 10 Beggar from giant firms. Match return expectation to company size. In chapter 8, there is no perfect stock, but there are the ideal characteristics. The goal is to find companies that are easy to understand, profitable, and growing. Simplicity is a major advantage of a stock. And then we must avoid hot and heavily promoted stock, because when expectations are too high, disappointment hurts the stock. The key point is the great stocks are usually simple, boring, profitable, and ignore not exciting, complex, or fashionable. And then in the chapters 9, stock identified, Peter Lynch says the most dangerous stock are the ones with best stories, not the best fundamentals. Growth without profits, we must avoid it. Over diversified companies and treat promises of future profits for constant restructuring, and last, business that you can understand. The last chapter is what counts, what doesn't. If the long run stock price follow earnings, everything else is noise. The key point is why earning matters. Stock price follow earnings over time. Short-term price are unpredictable. And to compare earnings over time. 1 year is not enough. We must review 5 until 10 years of earning. Look for the trends, not just a single data point. And 3, what's warning signs include declining earnings, increasing volatility, profit without sales growth. We must investigate the stock before investing. 5 basic ways a company can increase earnings. First, reduce costs, raise prices. 3, expand into new markets. 4, sell more of its product in their own markets. The last, revitalize, close, or otherwise dispose of a losing operation.
In Chapter 11, the 2-minute drill, Lynch stresses that before buying stock, you must be able to summarize your investment case in a short monologue. The rule is simple: if you can't tell the company story clearly, simply, and with the conviction in just the 2 minutes time, then you do not buy the stocks. This is the job for the investors, knowing the story about why the stock is needed to be bought. The story that Lynch pointing is above than just profit and earning ratio or the company classification. And it is not just what the number says, but the actions taken by the company. What do they do to increase their profits? Is it aligned with the numbers? Is there any related strategies that the company runs? The next thing Lynch explains is to identify the phase based on the actions and the status of the company. Each phase has their own risk, and your expectations must be aligned with the risk tolerance based on the phase. In chapter 12, Lynch wrote about what charts are saying. In this chapter, we will focus on the link between price and earnings, the fundamental analysis, and the relationship between stock's price and its financial reality. There are 3 key points in this chapter. First of all is the earnings line. Over the long term, a stock's price will follow its earnings. If the earning line goes up, then the price line will align. The second point is the PE, or the price to earnings ratio. This point is about timeline, how long it will take for the company to earn back our investment. The buying concept, Lynch recommends to buy when the stock price line lags significantly behind the earnings line, or in most cases when the PE score is low. Lynch also highlighted that we must avoid buying when the stock price has a wide range above the earning line. In short, you might have heard to invest in the lowest price or to buy at the lowest price, but Lynch elaborated that the low price defined aligned with the earnings line. In chapter 13, Getting the Facts, Lynch explains about the turning customers' edge into convictions. There are practical steps for an amateur investor to research a company and gain edge over a professional. The first one is using your edge, starting with the company we see succeed in our daily life. And the next one is to call the company. Do not hesitate or be afraid to call investor relations. A simple question as in also recall relations to the story in chapter 11 before. For example, what is the percentage of sales is the new product? What are your long-term expansion plans? And what is your debt situation? And other questions you could feel relating to your investment. The next one is to visit stores to see real conditions of the company. After that, seek for annual reports. Focus on the balance sheet, specifically on debt, the cash position, and the letter to shareholders. And look for hidden assets that sometimes are not reflected yet in the stock price. In chapter 14, Rechecking the Story, Lynch states that owning a stock requires ongoing monitoring and defines when the story is broken or is it the time to sell. After a few months of investment, check if the story is still intact. Is it successful, or is it if the growth rate has slowed down? Is it the debt has reduced, or is the company has lost the unnecessary division? When the PE ratio starts to detach from the company growth potential, for example, it becomes widely overvalued, then it is the time to sell. The important part that Lynch wrote is never to sell a winner just because it's gone up. If the fundamentals still improving, then hold still. In chapter 15, the final checklist, Lynch demonstrates a practical checklist to apply his principles before committing capital. Understand why we own the stock, and can we clearly classify the stock? Recheck the PE ratio and the growth. Is it equal or is it lower than expected? For financial safety, always seek the healthiness of the company based on the balance sheet. Is there enough cash relative to that?
Chapter 16, Designing a Portfolio. In this chapter, Peter Lynch says diversification is good, but owning too many stocks can hurt performance. Individual investors do not need hundreds of stocks. They just need about 10 to 20 well-researched stocks are enough. Some stocks will fail, and that's normal. The important part is a few good stocks can cover the loss. So the main lesson is if you don't need to be right all the time, just avoid big mistakes, then let good stocks grow. Moving to chapter 17, the best time to buy and sell. Lynch explains that trying to time the market does not work. So the best time to buy is when a company is proving but the market has not noticed it yet. Market drops are normal, so investors should not panic. Stocks should be sold only when the company's business changes or grows slowly or the stock becomes too expensive. Moving to chapter 19, chapter 18, the 12 silly things people say about stock price. This chapter talks about common stock market sayings that can mislead investors. Phrases like it can go lower or blue chip stocks are always safe are often wrong. So any stock can fall. And even big companies can perform badly for a long time. So the key reason is for this chapter is that risk comes from not understanding what to invest in. So you have to know what you invest in. Moving to chapter 19, options, futures, and shorts. In this chapter, Lynch explains that options, futures, and short selling are too risky for most investors. These tools are complicated and can cause big losses. Lynch believes investors do not need these tools to be successful. So simply buying good companies and holding them long term is enough. Moving to last chapter. 50,000 Frenchmen can be wrong. In last chapter, Lynch explains that why independent thinking is important. When everyone agrees on stock, the opportunity is usually gone. So good investment often look boring or unpopular at first. So if you have done your research, you should trust your own analysis and do not be a FOMO instead of following the crowd.
That's all for the review. Overall, One Up on Wall Street promotes a disciplined, long-term, and common-sense approach to investing. The book encourages us to use everyday experience and professional insights to find a good companies early. It is a great book for beginners with little or no investing knowledge. So, what are you waiting for? Let's start investing. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.